Hi everybody, this is head trader Patrick. Before we begin today, please help me out by hitting that like button and subscribing to get notified as these videos come out. With a basic understanding of how to trade, here's another trading hack video showing you a clever way to apply what we've been teaching. Hi everybody, this is head trader Patrick and welcome to another video in the trading hack series. This one is entitled Beware the Bubble. Now when we think about bubbles in the stock market or in a stock, we tend to think of these much longer time perspectives that a bubble will form over months and years. And I tend to think of the one that happened in 2000, 2001 with the NASDAQ, and even 1999. That was just this huge bubble developing, and that tends to be how it happens within markets. But within individual stocks, with respect to spread trading, it happens very differently. And we'll start by going to the chart and showing you what this bubble looks like. Alright, so here's an example of a bubble. I have this chart poised and ready at March 2nd, 2021. And this is at home, ATHM. You can bring it up on your own charts if you like. And at March 2nd, this looked like a pretty good trade. You had this pretty nice run up, almost a basing pattern, and then at home took off a little bit, performed a pullback, and gave us a nice trade entry, or what looks like a nice trade entry. Down here we've got an indicator telling us it's time to get in, and otherwise you might otherwise think that this is a pretty good time to enter. But as it turns out, and I'm going to kind of roll forward a few days in this trade, you can see as we go a couple weeks forward in that trade, this ends up being a mess, about a 20% decline right there. So first of all, how do we assess a bubble on a chart? And we'll do that, and then we'll run into run the numbers and take a look at how ugly this type of a trade can be. So when assessing a bubble on a chart, I'll pull back the chart a little bit to 4 to 6 months and then just draw some basic trend lines on there. And sometimes you can't draw the trend lines, and so bubbles are impossible. We'll deal with that later in the numbers, but in this case it is possible. So let's draw some lines, and you can see from a trend perspective, there's kind of the top of the trend, and again with trends you don't need to be exact, just get it close. And I'll dial this top one down a little bit. Yeah, okay, good enough. And so you can see this this nice upward 6-month, 8-month channel with at home developing. And what's happening in that channel is that is just a classic sign of institutional investors getting in, multiple institutional investors getting into this particular stock. And so they're just chugging along, dumping money in, and something happens here at the end of January. I believe there was an earnings here, which wasn't that spectacular. But at that point, what probably happened is retail investors started to get excited about this stock, pushed it up further, and that's our bubble. And if you look at the top of the channel, which is about the 115 range, to the top of the bubble is about 140. So that's a 20+% bubble outside of the top of the range. So that's how you would identify it on your chart and try to avoid it. And if you can't avoid it, again, we'll deal with that later, but let's now take a look at running the numbers and see just how damaging these bubbles can be. So with this trade, or with this assessment, we'll assume that we have $2,000 at risk, and use that as our standard amount of risk. We're going to use average fill prices. I won't go through process of getting those through the backwards analysis with thinkorswim, but just know that you can get it. You can get those average fill prices. And when we rolling will be one of the techniques here to avoid total loss. That rolling will be immediate. In subsequent videos, I'll talk about a different way to roll, but I think immediate rolling is a common practice, and it's something I certainly approve of, and some other methods that again we'll discuss later. So let's first talk about the worst case. Let's assume that you made the mistake, you didn't recognize the bubble on the chart, and you got in right here at the what would have been a pretty good entry signal right here on March 2nd. What does that look like? Well, on March 2nd, you would have created this initial credit spread for $240 with the hopes of riding it through expiration and collecting all that premium. But just a few days later, this trade turned against you on March 6th. You had to roll that trade, and the net on that was $200 loss. Okay, so that was about a $440 trade just to get out of the first one, get into the next one, which is fine. Which is anytime your trade is going against you, you should absolutely roll. And then eventually, and then if you let that roll expire, that loss would have been 2,000. So the net of these sort of legs 1, 2, and 3 are a near total loss of 1960. And so your loss comes to a 98% loss. You would have lost all but just a few dollars, all but $40 of this initial investment. That's really unacceptable. And so that's worst case. And by the way, a lot of people do the worst case. They enter the trade, they don't understand the rolling flow chart, and they eat a total loss on a trade like this. There are other options. So the first option is we'll call this the best case. And the best case would involve waiting until, again, you were back towards the bottom of that channel right here on March 10th. You would have got in, and you would have seen total profit on that trade. That's best case. And at best case, you would have got, because it had dropped further, those premiums would have got a little bit juicier. You would have got $300 worth of premium and collected all of it at a 15% profit loss, which is fantastic. So that's best case. Best case, you would have identified this bubble, and you would have identified the channel and made the correct choice. And sometimes you can't identify the bubble. Either the chart doesn't look good enough, or even with a good looking chart, it may drop even further. And so you may pick the bottom of the channel, it may fall further than that. It happens, and you have to know how to kind of roll with that particular loss. And so I added this third choice, and I call this the hybrid. This is if you were to, for whatever reason, you didn't see the channel, and you entered on that March 2nd date, which is fine. I've done it. We've all been there. And just so you know, you have options, and that option is to first of all create your initial credit spread for 240, roll the trade one time for a net loss of $200, and then roll it again for another loss of 240. Now on that third leg, it ended up that second roll ended up being profitable, meaning you could let that option go to expiration, and you wouldn't lose any additional money. And so even with that initial 240 and the two rolls that were net negative, you only lost $200 for this trade. So you only lost 10%, which compared to the near total loss of 1960 on the 2 slides up in the worst case, that's a pretty good option. So when we compare all these together side by side, we realize the best case, obviously, is to be able to identify the bubble, make a smart decision based on trend lines, and where those entry signals fall within the trend lines. Are they falling at the top of the trend line after the bubble, or is there a significant drop back to the lower part of those trend lines? And then entering the trade at that point. Can't always get that best case, but that's what we're going to aim for. And the worst case down here at negative 98%, obviously terrible. And then the worst case plus rolling, continuing to roll, gave us a negative 10%. Now in my own trading, I've had to roll a maximum of 3 times before, where the total, the stock moved. I think it dropped down about 28% total from my entry point. And on that one, I think I lost 23%. Again, not great, didn't feel great, but it sure beats a total loss of near 100%. So with that rolling, you have great options. And so lessons from Beware the Bubble are, number one, learn to identify and avoid that trade if you can, delay that trade, and then add that technical analysis, that channel, that bubble check to your trade checklist. This should be something you look for, kind of backing out to the 6-month level, looking at the trends and trying to see if you are in a bubble, and then avoid it. And then when you are in a bubble trade, and again, you will get there eventually, it is somewhat unavoidable in a complete sense, but never let a losing in the money spread expire. If your spread is trending towards becoming in the money, roll. And roll once, roll twice, roll 3 times, however many times it takes, because a 10% loss is a heck of a lot better than a total loss. And that's one of the big takeaways from Beware the Bubble. It is avoidable in most instances, but if it's not, roll the heck out of it and protect your profits. Thanks everybody. Have a good day.